Hey everyone, it's Alan back again, and today we're going to be taking a look at a brand new ETF that was just launched last week called the SoFi Weekly Dividend ETF, which promises to pay dividends to shareholders every week as opposed to every month or every quarter like most stocks and ETFs do. A lot of you probably remember a video I uploaded a few months ago in which I discussed SoFi's other weekly dividend ETF, which is ticker symbol TGIF, which pays dividends every single Friday. At the end of my other video on TGIF, I came to the conclusion that even though the idea of getting dividends every single week was a really pleasant thought, it just wasn't a good deal for several reasons. The dividend yield is very small, and it doesn't have enough room for growth. Not to mention I thought the share price was pretty insane at over $100 per share. If you want to learn more about that, I'll leave a link to that video in the description of this video. I was meaning to make a video on this ETF sooner, but I wanted to wait for the fund to announce its first dividend so that way we could calculate what its dividend yield is. But just looking at this new ETF, I can honestly say that this one does appear to be better than TGIF. But just because that it's better doesn't necessarily mean that it's still a good investment, right? So in today's video, we're going to take an in-depth look into this brand new weekly dividend ETF, which alongside TGIF are the only two funds out there that pay dividends weekly. And we're going to try to determine if this ETF is worth actually holding or not. Before we get started, if you're interested in high-yielding investments where you can earn a large amount of passive income, please consider clicking the subscribe button below. Dividend Bowl revolves around aggressive dividend investing for people who want to earn large amounts of passive income sooner rather than later in their lives by targeting higher-yielding ETFs, stocks, closed-end funds, etc. So if that sounds interesting to you, feel free to subscribe and check out some of my other videos for more content. Now with that being said, let's get into it. According to SoFi's website, it says get paid weekly with the SoFi Weekly Dividend ETF. Ticker symbol WKLY seeks to provide investors with consistent income by tracking the SoFi Sustainable Dividend Index, made up of the most consistent dividend-paying companies globally. Securities selected for the index have maintained their dividend payouts for the last 12 months, been forecasted to continue to pay over the next 12 months, and have met a number of additional screens designed to remove companies at risk of reducing their dividend payouts. Holdings are weighed by market capitalization and rebalanced quarterly. If we scroll down on this page, we can see one way that WKLY is a better ETF than TGIF, and that's in its expense ratio. WKLY has an expense ratio of 0.49%, whereas TGIF has an expense ratio of 0.59%. The primary reason for this is that WKLY is a passively managed fund, whereas TGIF is actively managed. A passively managed fund is where there isn't a fund manager hand-selecting what stocks and bonds go into it, whereas an actively managed fund has a portfolio manager picking every single individual holding that goes inside the ETF. As you can probably imagine, actively managed funds are more expensive than passively managed ones. Because after all, someone's got to pay that fund manager to do research and make predictions on every single holding in that ETF. Although WKLY is cheaper from an expense ratio perspective, it's actually considered to be pretty expensive for a passively managed fund. If you compare WKLY with, say, the iShares Core S&P 500 ETF, ticker symbol IVV, that has an expense ratio of just 0.03%. But hey, IVV doesn't pay dividends every week, right? So if you're serious about wanting dividends every single week, unfortunately it looks like having to pay a higher expense ratio is going to be the only option that you have. The next step we want to take in analyzing this ETF is to look at the holdings inside of it. After all, according to the fund's description, it's made up of the most consistent dividend-paying companies globally. When we open up the holding spreadsheet that's on their website, we can see this fund holds a lot of Japanese stocks, which I thought was pretty unusual. Since I'm in the United States, it makes it a lot harder to research these individual companies. I guess in Japan they take their dividends really seriously, but I'm just not really familiar with any of these companies listed. If you scroll down though, you will start seeing US listed securities, and there are some good companies here. But I guess with some of these, I'm still a little perplexed by some of their choices. For example, there's REITs in here, like Essex Property Trust. If you aren't aware, dividends received from REITs are taxed differently than dividends received from stocks like Johnson & Johnson. Dividends received from REITs are taxed as ordinary income, while some of these other stocks are taxed as qualified dividends. This made me curious, so I checked out ETF.com, and according to this website, the dividends you'd receive from WKLY are taxed as qualified dividends, which is good. But I guess I'm not sure why this ETF would hold securities that are taxed totally differently than others. Don't get me wrong, I think Essex is a really good REIT, but I'm just not sure what it's doing in this ETF. Other than that, I was expecting this fund to hold plenty of consumer staples and dividend aristocrats that are super safe, since SoFi wants to deliver on their promise of consistently paying dividends every week, and this ETF certainly has plenty of those. There are some dividend aristocrats here, like the 3M Company and Emerson Electric, among others. Then there's other companies here like CVS, who haven't increased their dividends since 2017, but the main point is I'm not seeing any companies on this spreadsheet that have ever dramatically cut their dividends, which is another really good thing. If you saw my other video on TGIF, you might remember that ETF held corporate bonds as opposed to stocks. That made it a little more difficult to do research on each individual bond. But since WKLY holds mostly stocks, that does make it a lot easier to perform your own due diligence. So that's again another way that WKLY, in my opinion, is a better ETF than TGIF. But now we need to answer the most pressing question we have on this ETF, and that is, what is its dividend yield? Because this fund is so new, no financial website that I could find has calculated the dividend yield. So we had to wait until this fund announced its first dividend distribution, which it just did a few days ago. Going forward, WKLY plans to pay 2 cents per share every Thursday. So with this information, we can now calculate the dividend yield for WKLY. In order to calculate a stock's dividend yield, you need to take the yearly dividend amount and divide it by the stock's current share price. So if we take 2 cents and multiply that by the number of weeks in a year, 52, we get an annual dividend of $1.04 for every share of WKLY that you own. Now if you take $1.04 and divide that by the fund's current share price, which happens to be $49.56 as of the making of this video, that leaves us with a current dividend yield of 2.09%. That's a really small dividend yield, and it's pretty comparable with TGIF. It's definitely not going to allow you to live off dividends anytime soon unless you already have a ton of money to invest in this. You can put your money into a lot of different stuff out there without bearing any additional risk and still collecting a higher dividend amount. Johnson & Johnson has a higher dividend yield, and on top of that, you don't have to worry about fees because there's no expense ratio. In my opinion, I think the only people who would benefit from owning this ETF are people who enjoy the emotional high of seeing dividends being paid into their brokerage account every week. If that would truly give you a lot of happiness, then I guess WKLY would be a good ETF for you. But if you want to get a much larger amount of dividends, there's just so many better options out there. Plenty of ETFs from iShares and Vanguard offer much higher yields than WKLY. I know they don't pay dividends weekly, but in the long run, you're going to earn so much more money and be a lot closer to being able to live off dividends from your investing portfolio. But I'd be curious to know your guys' opinion. Do you think WKLY is a gimmick like I do, or do you think that I'm wrong and it's actually worth buying into? Feel free to leave your comments below, and while you're there, if this video benefited you in any sort of way, please click the like button below and also subscribe to the channel if you want to see more high dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that. Okay, that's going to wrap up today's video. Thank you all so much for watching, and I'll catch you next time. Take care.